Right, so stocks continue to slide over the past few weeks now. Seems like it's picking up the pace the past so many days. So we're going to talk about this consolidation that we've been anticipating and the different signs that suggests we are definitely in a consolidation mode, as well as, which kind of again confirms what we've been expecting, but also signs that we might be closer to the beginning of it than the end, that we still have a lot more to go. Not necessarily, we're not going to fall off a cliff or anything, but where and how much further it can drop and where things will really pick up the pace before we finish this pullback. That's kind of what I break down in today's. Taking a look at some pretty interesting moves in the dollar, pretty interesting moves, especially in bonds. So we've had, it's a little bit of a similar type of move the last couple of days that we saw in 2022, but not exactly the same. Commodities are kind of joining the party. Of course, the question will be when bonds and stocks break, as the market focuses more on deflation than inflation. We'll talk about that. The sector rotation is definitely skewing more towards the risk-off safety trades. So I'll show you what that means and how much further, like what that tells us in terms of how much further down we have to go. And then our trade idea is a stock in the industrial area that's in its own decline, and we'll talk about how to trade that as it's still kind of in the beginning stages of its consolidation, where it's not as bearish yet in terms of breaking down from a strong bullish move. So what kind of trade do we make? We'll talk about that. So let's go ahead and get started. Today is Wednesday, August the 16th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including the Market Outlook live video, where I do take a look at the trades we've done in previous videos, see whether we closed out a few of them today, actually. We put on today's trade idea before the market closed. That's at 3:30 Eastern time. Come down here to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. Click that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask for it every day. It's a big deal to us. Our goal is to get to 100 likes on Twitter. So we're getting closer there. So thank you those who like us day in and day out, and those who don't. You can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we're continuing lower, closing at the lows of the day today. Dark pink shading and a red line still, so we have started the intermediate decline from that perspective. We are now below the 23% retracement for the first time this whole time. So that, in fact, when I did my class earlier today, we weren't. So it was a late drop that pushed us through. It actually pushed the momentum line back to extreme lows, and the near-term line hit right near that 5th percentile. In fact, that's the lowest near-term level. You have to go way back over here to April for the last time we were that low. And of course, at that point, the intermediate line was actually in the reversal zone and stayed there because we immediately bounced back up on the momentum line. Not sure if that would be the case this go around. The intermediate line is a lot more bearish, and market sentiment still above the 80th percentile. You're still, less than 2.5% below the 30-day moving average. So we still haven't really broken that 2.5% mark. But I think you could clearly see that we are in intermediate decline now, even if necessarily, if you look at the zigzag, it's only a 4% decline. So we still, if we bounced up from here, you still wouldn't get a red tag if we were to go up to new highs. We'd push that 19% higher. The red tags only come when you get the 5% or more drops on a close-to-close basis. So keep that in mind in terms of whether we actually have had, and of course, a correction. I mean, again, it's 5% plus or minus a few points, and then 10% plus or minus a few points for a correction. And of course, we still got a long ways to go if we get into that situation. Your Dow Jones Industrial Average has joined the party. They have got that bull tag yesterday, continued down another 0.5% today. Both short-term sentiment lines dropping to extreme lows. The near-term line down below the 5th percentile. Your intermediate line now dropping a lot more rapidly than it was before. So it finally has joined the party. The NASDAQ actually got a cluster today of all things. Can you imagine? You got a cluster on the NASDAQ 100. The intermediate line is in the reversal zone. We have broken that 23% retracement. We have the dark pink shading and a red line for a couple of days now. We haven't had a cluster since way over here. And of course, we were way below the moving average at that point. We were 7% below it there. We're only 3% below it now. In fact, this is one of the lowest, considering the intermediate line getting into the reversal zone. This is one of the lowest levels of the that we've been. If you follow my cursor to the left, you can see over here. So here's this the last time the intermediate line was in the reversal zone. We were a lot lower than this 3% mark, and then over here, again, here's where 3%. As you can see, we were a lot lower. So this is one of the weakest pullbacks, especially to produce a cluster. Now this cluster produced a little pre-CPI rally back in September of last year that failed, and we ended up going down. We'll see if this cluster ends up being similar or any different than the last time. My expectation is it's going to continue. You finally got dark pink shading and a red line. Short-term sentiment for the Russell is the worst. It was down 1.25% today. It's both of the momentum and near-term line actually hit zero. I mean, that hasn't happened in who knows how long. I mean, maybe over here. I mean, not even really over there. Like both lines at the lowest point they could possibly be. The Russell has gone from being relatively strongly bullish to this plummeting way more than the other indexes have been, at least especially in the last few days. If you take a look at the ratio chart here, right here, you'll see that this ratio chart is actually rising the last couple of days, despite the fact that we've been falling, and a lot of that's weakness in the Russell 2000. You wouldn't expect it to last very long. You would expect that the Qs will roll right back over, and things will really get bearish at that point, if that were to happen. So you can see that things are really turning south. I showed you the Nasdaq. Yeah, I showed you the Nasdaq there, and then the Dow, of course. So things are definitely turning south on the markets. So as we've been talking about, right? We've been in this convergence mode for a while. We've been expecting consolidation. It's been slowly coming, and now we have 3 red arrows across the board. I mean, all across the board we have 3 red arrows. And it's been multiple days on the Qs and the S&P and the Russell, so we are clearly on this chart in intermediate decline. Of course, as most of you all know, because the TV's been talking about it and everybody on Twitter's been talking about it, but we drop below the 50-day moving average. We're still below the 50-day moving average today, and now breaking that 23. And again, you break that 50, and the threat is that you fill in the gap between the 50 and the 200. And there's a pretty decent gap there, at least down to this 4,200 mark, where there's going to be a very strong support level. A little mid support here at 4,300, but 4,200 is where the strongest. And probably by the time, if we were to hit it, your 200-day moving average probably be pretty darn close to it. And that's going to be, that's going to be the level that's the key, right, to whether or not we actually go into correction mode or whether it's just a pullback. Remember, corrections start with a pullback and then a failed pullback bounce. And so the longer we go, if we do go down to 4,200, you'll be down to that 50% mark on the intermediate line. It makes it more and more likely that we will get a failed pullback bounce, where we don't bounce up to new highs and then we roll over at that point. So keep that in mind. Of course, your Dow has been the most bullish. It's finally down below the 30-day moving average. The Qs, on the other hand, are clearly below the 50, right? And in fact, the 8 and the 17-day moving averages are crossing below the 50. The 8 has, and the 17 is close. I mean, your MACD is just kind of turning bearish. You can see it's been a lot more bearish when we've been. It's been a lot lower when we've been more bearish, and you can see the size of the gap, and you can see the size of the gap in volume. Like, there's a pretty sizable drop the Qs can make down to its next layer of significant support down to the downside. Now let's start checking some of these other indicators and see just how much we've started this intermediate pullback. The negative indicator still hasn't crossed above 25 yet. It is above the positive. The positive has crossed below 20 for the first time, but you still haven't really gotten going there. The RSI and the CCI, We are below 40 now. This SPX has dropped below 40. So you could say here that this, as of right now, of course, we'll see if this is a little bit of a fake out pattern. But you could say that yesterday this has ended, and we might be able to start a little bit of a red move here as we drop below 40 on this chart, and might even actually end it more closer in this area by the time we actually started to pull back. Of course, also at that time, you can see that was also the time where we broke below minus 100 on the CCI, and now we're at minus 150 again, and we are at bearish levels on the major index, the SPX. Of course, we are bearish on the whole. We got the parabolic SARs dropping. We're down in negative levels against the 200-day moving average. We got pretty sizable bearish candles. A lot of things kind of working against us. You can see minus 87 is the lowest level we've seen here in a while. So if I were to change this line, minus 87.2, you can see you get this bad of breadth. It typically leads to more weakness than what we ultimately may be comfortable with. So very significant weakness there. Looking at the Ichimoku cloud, we have a weak trend developed. So we have now transitioned from a very mature bullish trend to a weak bearish trend because we're below minus 1, we're above 50. These intermediate pullbacks typically kind of end here. So let's see if that ends up being the case. Of course, if we're going to get above 65 and above 2 or below minus 2, now we're at intermediate trend strength, and that starts to increase the likelihood of, again, another correction here. So we are still above the cloud. We're barely negative on the rate of change. Let's see if this ends up being where support is, and we bounce. I don't think that's going to be the case, but there is a support level based on that indicator kind of at around these levels right now. We are in the lowest quartile now. Clearly, this is the first day we've been clearly in the lowest quartile. Of course, the bands have crossed outside of the Keltner channels. You got the green dots as a result, and you're increasing momentum. If you follow my cursor to the left, you can see this is decent momentum, more bearish than what we've seen in a while, months, but it's not very bearish compared to other intermediate declines. So you can see how there's a lot of indicators suggesting that we are starting our intermediate drop here, and a lot of indicators suggesting we are just starting, like that we're a lot closer to the beginning of this intermediate decline than we are to the end of it. You can see the Arun indicator bearish. We saw that bearish breakout before. That's one of the reasons why we've been anticipating consolidation. Of course, the diamonds just barely finally is the last one to give us that indicator yesterday, and then confirming that here today. So we are with the lowest change sideways, the lowest 4-week range. You can see clearly breaking down, very, very top heavy on the Dow. So very decent potential for weakness to the downside here. The volume was above average, 80 million. The range was above average too, not strong above average. So remember, when you get these above average numbers that start bringing these up, but they're not extreme, because when they're extreme, then you start to worry about. Basically, it's so extreme that you'll just bounce right off of that. But that's not the case right now. We're not getting extreme moves to the downside. We've been actually kind of picking up the pace gradually here, and that's, again, another sign of a more steady intermediate decline, one that's not going to end sooner rather than later, one that may be just, again, that may be just beginning. Because if you look at the VIX is up, but it's not up very much. I mean, it's at 17. I told you before that intermediate declines typically start with a VIX move up to 100 or 105% in this area, either at the start or at the finish. And so this looks like the type of decline that will be more the type that ends with a jump in volatility, as we haven't even broke. If you look at this chart, you would think that we are pretty darn bullish on the markets right now. The fact that it's not above 90%, and you can see that's clearly not what the VVIX is telling us. The VVIX is pretty darn high, about almost as high as it was during at the end of May, and the VIX is nowhere near 20. So the VIX is still very depressed, still very low. We haven't seen the worst if this is an intermediate decline that persists, which I expect it will, we haven't seen the worst of it yet. As you can see, we are above the 50-day. All these moving averages are crossing. You're not above the 200-day yet, which kind of is another sign of intermediate decline from a volatility standpoint. So we are clearly nowhere near the end stages of this level, where you get that. You can see from a seasonality standpoint. Again, we're also kind of still in the early innings of a seasonally bullish run of volatility that takes us through the next couple of months, which are, traditionally September and October. A lot of people just don't like those months, and this is the reason why. This is when volatility, and starts in August, but it's when volatility starts to pick up. You also notice too, again, intermediate declines typically start with a 2% drop and a pretty decent gap. The closest we got there was on August the 2nd. I told you that's the best potential we have for a runaway gap. We still don't have a 2% decline yet. I mean, we didn't even get a 1% loss today. I mean, we still have only really 2 days of 1% declines, and they're pretty small 1% declines. It's not like we're knocking on the door of 2% here. 1.4% was our biggest loss, and then yesterday was 1.16. That's not that big of a deal. So, again, we're inching our way into this move, and we haven't really felt the brunt of it yet. And when it does, then things are going to feel uncomfortable for people. Then we're going to start worrying about these high yields, and there's going to be a lot of narratives out there as to why we're bearish. But from a technical standpoint, this convergence we've been in for the past month or so, and then this last few weeks, where we've been anticipating the consolidation, now we're seeing that it is consolidating. And like I said, I think we're a lot closer to the beginning than we are to the end. I think we are gonna work our way down towards that 200-day moving average by the time we start what ultimately may be a failed pullback bounce that leads to a correction. All right, now let's take a look at what's driving this price action. So let's come over here to the asset class comparison chart. You can see things are going down, but what's interesting is with the drop in equities, similar to 2022, we're actually seeing a pretty decent drop in let's go to just today, in bonds as well. So bonds, you saw, have the worst performer over the last 3 months. They were down pretty significantly today. You can see IWM, the Qs, real estate, emerging market, international equities all down. The dollar is up again today. Commodities are not up, but they were outpacing. They outpaced bonds. They didn't outpace global bonds, but they outpaced U.S. Treasuries. They outpaced corporate. They did not outpace corporate bonds, but they outpaced equities here. So they weren't up, but they were up on a relative basis. Yields, of course, are up. As you saw, yields here, and you look at the 10-year yield closing at 4.26%. Very, again, one of the highest close we've seen in years, as the highest close previously was 4.23. So we have eclipsed that number. And again, you'd think, oh, must mean the Fed's going to raise rates. Nope. The odds for a rate hike have not budged. So these rising yields are not leading to a Fed rate hike expectations. As much as people might talk about it, don't buy into it. That's not what's going to happen. The 3-month yield would tell us if we were going to get rate hike odds increasing, and you can see they're not. Here, let me get back to a regular. You can see they're not increasing. This is the level. You're at 12.5% odds. We're not getting. In fact, even for November, you're still at about 38%. It's higher than 30, but it's still low probability. It's still below 40%. So it's still higher probability we're not going to get a rate hike in November. And you can see by December, it's up to 64% of no rate hike. So it actually starts to increase. Of course, the issue is March. Are we going to get a rate cut in March? And as of right now, you're looking at about a 40%. So you're at 41% or higher. The odds of being here in March are up to almost 60%. You're about 40% odds of a rate cut in March. That's down from a month ago when it was over 60, close to 70% there. So the odds are a lot higher of a rate cut by starting in March. It's down to 40%. In fact, when you look at a month ago, you were 100% odds of a rate cut in 2024, 90% odds of 2 more, so 3 rate cuts, and then 95% odds of 4 rate cuts, 95% odds, and then down to about 80% odds of 5 rate cuts. If you go out further here, you're looking at a pretty decent likelihood. That was what 16%, 16, 17, 18, just about 18% odds that we'd be at this level or higher, 425, 450 or higher. Now you're looking at about a 45, 55, almost 60% odds that you're going to be at 425 or 450 or higher. You're going from 18 to 60%. So again, the odds of these rate cuts are really dropping dramatically, and that's what you're seeing in the 10-year and to a degree in the 2-year. The 2-year is pricing in rate cuts, but maybe like only 1 or 2 in the next little bit. This is the path forward. This is what we're doing right now, the 3-month. And of course the 10-year, this is the problem, right? This is the issue. And you're getting this inverted yield curve uninverting, and when this uninverts, if this makes it up to 50, 25 basis points, because it kind of moves in stages here, then it's generally going to put pressure on equities, not the other. It's when it falls, it's when it's actually bullish, and the downside is more limited, because again, if it were to falter down to the downside, that would mean that rate hike odds would have to start to increase with the 10-year staying, and they're not going to raise rates anymore unless the CPI runs up above 5%. But that's we're running up towards 4, but probably not as likely that it will get up 5.5, 6%, where the real Fed funds rate turns negative again. I don't think they're going to hike rates again until the real Fed funds rate turns negative, and they're not going to cut rates until it's been at positive 250 basis points for a while, similar to the 90s here. They're transitioning from what's traditionally been a negative real Fed funds rate environment to one that's positive for longer. That's what the higher for longer means. So yeah, you got some interesting moves here. TLT is so oversold. TLT, you can see getting 4 clusters in a row, 6 of the last, I don't know how many, 10 days or so. Very, very extremely oversold. You gotten 2 clusters in a row on the weekly chart. And now granted, over here you had 6 out of 7 weeks of clusters, and over here you had 5 out of 7. So you can get a cluster. Over here you had 4 out of 6. You can get a cluster of clusters on the weekly chart, and that's kind of what we're getting. Now you're more than likely not going to get TLT dropping, like the MACD is more than likely not going to drop down below these levels. So as we threaten these old lows from last year, and the stock market's nowhere near its October lows, you as a result, you don't have a whole lot of downside. In fact, if the market were to retest its October lows, you'd most likely see bonds start to turn higher. So it will transition from selling along with stocks, which is inflationary, to selling or being bullish when stocks sell off, which is deflationary. So you'll see when the market makes the concern being from inflation to deflation will turn when this turns up and the markets stay south. That's when deflationary concerns will start to rear their ugly head. At that point, Fed rate cuts will occur, and that's what really exacerbates the correction and turns it into something more than just a correction. Let's take a look at the sector rotations. Let me bring up the sector chart. And we'll look at the sector comparison here. And again, just looking at today alone. Again, it hasn't, you got these other cyclical areas, but you see in the last couple of days, remember how we talked about, I think it was on Monday, where these 3, technology, communication services, discretionary, were more bullish, and we're like, more than likely this was just a pause. We're probably forming the high for the week, and we're probably going to end up being south by the end of the week. Well, these 3 sectors, which had started the week so bullish, have turned south. So they ended up, again, you can see their strength early on Tuesday morning, but now you can see discretionary is down, communication services are lagging the S&P, technology is down for the week, still outperforming, but to the last this day today has really seen the weakness in these areas. You can see now down where you're in the last 2 days, especially your safe havens, still down 1% or more, but outperforming, right? Utilities, healthcare, staples, all outperforming. Real estate, which is typically a safe haven, is not, because that's part of the reason, part of the problem for a lot of this weakness is what's going on in that real estate market, especially the corporate real estate market. Let's quick look at the 12 grid. I also mentioned on Monday that the 12 grid was also not suggesting that we were going to be bullish, and that Monday was just probably temporary, and you see that now. Dark pink shading and a red line across most of the sectors here, almost on industrials and financials, and discretion or communication services now has the bull tag, and then really what's holding up is energy and healthcare, and you can see they're starting to roll over. I mentioned that before as well on this, on the well, first of all, you can see on the new highs and new lows down below minus 300 now, another indication that we are in the intermediate decline. As well as the number of stocks above the 50-day moving average has plummeted. It's almost now into bearish levels below 200, way below the 300 mark. The number of stocks above the 200-day moving average is also plummeted down. Hasn't broken the 50% mark, but is out of the bullish territory, being above the 60% mark, above 300 stocks. But the rotation, you can see, the rotation is clearly moving into kind of these safety areas. If you look at the daily rotation in particular, so you can see the biggest momentums right now are still discretionary, healthcare, and a lot of that has to do with discretionary here. Are those two main names, Tesla and Amazon. Amazon especially with the earnings, but you remember when the earnings came out for Amazon, we talked about it as more than likely based off a past precedent that Amazon was going to fill in that earnings gap. And when it did, that's when things were going to really turn kind of south for the market. So here is Amazon now filling in that earnings gap, right? And Tesla, of course, has already been more bearish. We've had a trade going on there in our class portfolio, and expecting that to be more bearish. So really that's Amazon with that momentum. And you can see the rest of the momentum is staples and healthcare. Energy still has a lot of momentum and relative strength. Utilities are starting to pick up the momentum. It's got, along with real estate, kind of some of the biggest change in momentum that we see here. And so we are shifting away from XLK, which is down to the left pretty significantly, XLC, which is down pretty significantly and moving over, and then XLY, which is still kind of on the left. And you probably don't expect that it will clear into the green before rolling down and moving back down where XLK is. All right, that brings us to our trade idea of the day. I'm going to take a look at Deere. Deere has been really, really bullish. Part of this increase in industrials the last couple of months, the Dow's outperformance. But Deere has really broken down. You got a little bit of a head and shoulders, and you've broken below whatever trend line you would draw between these two lows. And you've broken the 17 and the 30-day moving average today, closing at the lows with a long upper shadow, which is bearish. You can see the MACD below its moving average, flirting with zero. Stochastics flirting with getting back into bearish levels. Pretty decent volume the past couple of days as well, as you can see. Above average volume there on the decline today, as we're headed towards earnings announcement on Deere here pretty soon. Taking a look at its market forecast charts, you can see it's like most of the broader market, giving these bull tags, which for a lot of stocks have been the beginnings of these bearish moves. You look at like some of these other oscillators for Deere. You're moving up. The positive is down at its lowest level that it's been. It's been so strongly bullish. You'll see that, in fact, on all these charts were so extreme in their bullishness, and now not in those bullish levels anymore. Not necessarily at bearish levels, but moving towards bearish levels, but not definitely not bullish anymore. You can see you still got the red dots down there. You're not in the lowest quartile, but you're definitely in the lower half of the chart pretty clearly. And then when you look at like the Ichimoku cloud, you're not below the cloud or even in it. You're still actually pretty far above it. Pretty decent rate of change, pretty strong trend. But now you're not only below the green line, which is a sign of weakness on a mature trend, but you're clearly below the blue line, which definitely is a sign of weakness, and suggesting that the drop to zero on both of these is going to occur sooner rather than later. You can see the weekly chart too, which had been so bullish. It's been getting multiple transition candles the past few weeks, and you'd expect, again, when they're not too bearish, you don't have to worry about it, but this is the most bearish candle of the 3 weeks, and would suggest that this transition is probably the one that will lead to more of a bearish candle next week, and potentially the red arrow on DR. The other thing too is now we do have the red arrow on SPX, which is again another sign of weakness, that an intermediate trend is developing. And you still don't, again, like I said before, in terms of very weak pullbacks, that's still not a very big candle relative to some of these other intermediate declines that we had. In fact, relative to these weak intermediate declines, it's still a pretty small candle if you follow my cursor to the left. So it kind of goes to show, like the stocks like Deere, and everything else appear to be rolling over. And as a result, what I decided to do was come over here and do a bear call spread. So it's a bearish trade, but since we don't have, we're not breaking out to the downside, we're just kind of ending the upside, I decided to do the bear call spread, selling the 440 at the 35 delta, buying one strike away, which happens to be $10 away. That sets you up here for this trade, with a little bit less than 3/4 of our normal risk, but getting about what I normally would get with $1,000 of risk. So a pretty good reward to risk ratio, and our break even, you notice, is back up above these old highs. So we'd have to break back out to the upside for us to break even, at which point probably would be looking at a directional bullish trade. So I like the setup here, and with 30 days left, if we can get 50%, which is, we've closed out a couple bear calls that we've made here in the market outlooks videos here recently, because we have exceeded the 50% of maximum gain today, with still more than 20 days out, which means we can redeploy that. Instead of waiting for the other half, I can redeploy this amount of capital to try to make a full maximum gain somewhere else, because we still have time to make another trade in September. Once we're inside of 20 days, we can't make any more new trades in September. We're getting too close to the expiration. We'd have to go out to October, so in which case you just leave it and get the other half there. But if I can get half or more with time left to make another trade with that same capital and get a full gain instead of waiting for the other half, then that's kind of and I think we have that opportunity here on this stock, just like we did on those couple more recent ones that we've done, that we closed out today during the Market Outlook Live session. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.